The idea that more money always leads to more growth is a common misconception. We often assume that endless economic expansion is possible if we just keep investing. However, this assumption breaks down in developed economies. These economies have reached a point where additional investment yields minimal returns. This is the capital saturation point, a critical concept for understanding 21st century economics. Imagine pouring water into a glass. Initially, each drop fills the glass further. Eventually, however, the glass becomes full. Subsequent pours only lead to spillage. Developed economies are like that full glass. They have absorbed massive amounts of capital over decades. Adding more capital does not automatically translate into growth. This is not to say that investment is unimportant. It remains crucial for maintaining existing infrastructure and fostering innovation. However, we must acknowledge the diminishing returns on investment in advanced economies. Understanding this dynamic is crucial for policymakers, businesses, and investors alike. It compels us to rethink traditional growth models and explore new avenues for sustainable economic progress. The law of diminishing returns is a fundamental principle in economics. It states that adding more of one input while keeping others constant will eventually lead to smaller and smaller increases in output. This principle applies to capital as well. As an economy accumulates more and more capital, the return on each additional unit of capital tends to decline. This phenomenon is evident in real-world data. Studies have shown a clear trend of declining returns on capital in developed economies over the past few decades. For example, the capital output ratio, a measure of how much capital is needed to produce a unit of output, has been steadily increasing in many advanced countries. This indicates that more capital is now required to generate the same level of economic growth compared to the past. This trend has significant implications for economic policy. Traditionally, governments have relied on stimulating investment to boost economic growth. However, as economies mature and approach the capital saturation point, this approach becomes less effective. Simply injecting more capital into the system does not guarantee the desired economic outcomes. Capital saturation is not a theoretical abstraction. It is a reality for many developed economies today. These economies are characterized by high levels of capital accumulation, advanced infrastructure, and a highly skilled workforce. While these factors have contributed to their past economic success, they also create a situation where additional investment yields limited returns. This is not to say that these economies are stagnant. Innovation, technological advancements, and human capital development continue to drive progress. However, the traditional growth model based on capital accumulation is becoming less relevant. We are entering a new era where different factors will drive economic growth. Recognizing this reality is crucial for policymakers. Continuing to prioritize policies aimed solely at increasing investment may not yield the desired results in economies nearing the capital saturation point. Instead, policymakers need to shift their focus towards policies that promote innovation, enhance human capital, and address inequality. Japan's experience over the past few decades provides a compelling case study of an economy grappling with the implications of capital saturation. Following a period of rapid economic growth, Japan's economy stagnated in the 1990s. Despite massive government spending and near-zero interest rates, the country struggled to regain its former dynamism. Many economists point to capital saturation as a key factor behind Japan's prolonged economic slump. The country had reached a point where additional investment was not translating into meaningful growth. This situation was exacerbated by a shrinking workforce and deflationary pressures. Japan's experience serves as a cautionary tale for other developed economies. It highlights the risks of relying too heavily on capital investment as a driver of growth. While Japan's specific circumstances are unique, the underlying lessons hold valuable insights for policymakers navigating the challenges of a changing economic landscape. The concept of capital saturation has profound implications for economic policy. As traditional growth models based on capital accumulation become less effective, policymakers need to adapt their strategies. This requires a shift in focus towards policies that promote innovation, enhance human capital, and address inequality. Investing in education and skills training is paramount in a world where technological advancements are rapidly changing the nature of work. Fostering a culture of innovation through research and development support is crucial for creating new growth industries and driving productivity gains. Moreover, addressing inequality is not just a matter of social justice. It is also an economic imperative. High levels of inequality can stifle economic growth by reducing aggregate demand and hindering social mobility. Progressive taxation, social safety nets, and investments in affordable housing and healthcare can help create a more equitable society while also supporting sustainable economic growth. The capital saturation point compels us to rethink our economic objectives. In a world where simply increasing GDP growth becomes more challenging and potentially less meaningful, we need to consider alternative metrics of progress. These metrics should encompass broader measures of well-being, such as social inclusion, environmental sustainability, and quality of life. This is not to say that economic growth is no longer important. However, we must recognize that its pursuit should not come at the expense of other critical societal goals. A more holistic approach to economic policymaking is needed, one that considers the long-term well-being of both people and the planet. Ultimately, the capital saturation point presents both a challenge and an opportunity. It challenges us to move beyond outdated economic paradigms and embrace new models that prioritize sustainable and equitable growth. It also presents an opportunity to create an economy that works for everyone, not just a select few. By embracing this challenge, we can build a more prosperous and just future for all.